Welcome back, everyone. Rayce Robinson, your favorite Florida mortgage broker. And man, have we got some crazy data that's came in lately affecting the market, affecting interest rates. So I wanted to look at how high I think interest rates could go, at least based on how I'm reading the data and what it says. I found this article, just came out, 2022 is already the worst year for rates since 1979. Ouch, I am in the mortgage business. I can tell you I definitely feel that one. 2022 has already had its fair share of bad news for rates. This week, not to be outdone, it began just as another reasonable bad week with rates moving moderately higher but still safely under the recent 13-year high seen on Monday of May 9th. But it ended with one of the worst days on record in more than a decade. And why is that? Because on Friday, the red hot CPI index came out just showing more inflation where the prediction was really for that to start to stabilize, almost 1% higher. So goes inflation, so goes rates. And what's more interesting about that is not, as Wayne Gretzky said, I'm not going to butcher this quote, but it doesn't matter where the puck's at, it matters where the puck is going. And all markets are weighing the future out, and they are pricing in the future. So you can look here, this is mortgage-backed securities, and red is bad. Let's keep it simple. Green is good. You can see here, the mortgage-backed security market sold off. And what did that do? That bumped up rates a lot. You can see Mortgage News Daily, 30-year fixed rates now well above 5%, 5.85 is what they're saying. 15-year above 5, 5-1 ARMs just below 5%. Now, everyone's rate's different based on credit and all that kind of stuff, and you're actually in the market actively looking for a mortgage. I'm going to link to a video down below that goes step by step how to make sure you're getting the best deal on a mortgage, whether you work with me or someone else, how to know what a good deal is. But in general, rates, lenders across the nation now well above 5.5%, creeping more and more to that 6% rate, and that's a trend I think you're going to see continue. Now, one of the things when I was kind of thinking about where rates could end up, I was curious what average people think. So I looked in a bunch of articles. I just pulled one up. Have people think mortgage rates will cross 8% by 2025. This was a survey done by the New York Federal Reserve this week, predicting, most people think rates would be at about 8.2%. Personally, I think that's high, and I'm going to show you why I think that's high, at least what the data says now. Now, what I will say about predicting any market, this is a little bit of an oxymoron, but I think with any investing, you have to have loosely held convictions, meaning based on the data that you have now, you look at expectations in the future, and you have to be willing to pivot or make changes based on when that data changes. So one thing that does matter, and rates do matter, and this is one of the factors you're going to see play out in this market. Last year at this time, rates were 3.5%. So someone that's getting a $350,000 mortgage would be paying $1,572 a month, and these are rounded up a little bit. At 6%, which we're getting close to, that same payment would be $2,100 or $2,100, so almost $500 a month higher. So that means the same, more importantly than the payment going up. What that means as a lender, what I see this is that this person here now qualifies for a 265 mortgage when they qualified for a 350 mortgage just a year ago. And that's huge, and that is something that is going to play out in the market because the median price is not really, the median income is not really increased that much at all. There's a lot of cash in the market and some of these things, so that is definitely going to be a downward pull in the market where people do qualify for less as rates go up. So again, one of those things that we're going to have to see play out. I did look up, this is the Fed funds rate, and what the maximum prediction right now they have is to be somewhere around 3.29%. We're under 1% now. So that means their goal is to get the Fed funds rate at 2% with a margin up to about 4%, right? It's a range, and this is their target. So what I did is I took a graph and I traced 3% and 4% on this graph, and I looked at the Fed funds rate in red, and I look at mortgage-backed securities, mortgage rates in blue, and I went back and tried to figure out when, and I'm actually going to make this a little bit easier to read. Okay, so I zoomed in a little bit here so this you could see this. So this is at 3%, the Fed funds rate. This is 4%. The blue is interest rates and the red is the Fed funds rate. So you can see they're definitely correlated. And this is kind of where we're at now, right? So I looked back, when have we had the Fed funds rate at 3% in the modern era? Because they changed the way they calculate some of this data. So if you look too far back, it gets a little dicier. But the last time that we touched 3% on the Fed funds rate, well, magically rates were 5.5%, which correlates about where they're at now. And then if you go to 4%, rates were just above, 6.25, somewhere in there. So the interesting thing is, obviously the Fed funds rate is not 3% yet, but the interest rates are already like it's 3%. And why is that? Because the market is pricing in the Fed funds rate at the target that the Fed has set at 3%. So the market has already priced all that in, which can be very confusing, because if the Fed raised the Fed funds rate for the next 3 meetings, you actually could get interest rates not move at all, because most of that is already priced in. What will move the needle on rates is what the Fed says in those meetings, and if they raise their target, then the market will correct, which the Fed is notorious for overcorrecting. So that's why, and many times in the past where I've been involved in the mortgage industry, where the Fed has raised rates but interest rates went down based on what their target was moving forward. And there are some experts, and when I say some, a lot of economists, predicting sometime next year, 2024, for rates to be really low again, as potentially unemployment rises and some other things, forcing the Fed to really decrease the Fed funds rate and deal with that, which is not really a good position for the Fed to be in if inflation's high and unemployment's high. So that to me sets the cap. I want to show you one other thing too. I did kind of lay this. You could see here, this is median income, hardly changed at all, which is really crazy. So median income not really changing, and you can see here prices climbing. This gray shaded area is any time the real estate market has went down. So really, it's been a long gap between any time the markets went down, and this is 2006. You can see here, if you'd have bought at the height of market in 2007 or 8, really 6 years later, you were even again, which goes back to that. It's just so hard to time the market. You're never going to do it. I was around in 2008. Prices are going down. People don't buy, and then the prices start going up. People think they missed it, so they don't buy. So again, trying to time the market at this point, again, Fannie, Freddie, CoreLogic, all of these, Zillow, no one predicting any type of negative appreciation. They're predicting really 3% over the next 3 or 4 years, which is really low, because if you think about it, that's a flat market, right? That's really almost no appreciation, and that's currently what's being predicted by a lot of the big banks. So where do I think the cap is? And the point of this video, I really think the cap for rates is going to be somewhere right around 6, on the high side, 6.5%. I really think unemployment comes up and the Fed is going to have to stabilize on raising the Fed funds rate. Remember, they are trying to slow the market down. That's why as the Fed raises rates, you're going to see increasing inventory. You're already seeing some markets cool off, right? That is the point of raising the Fed funds rate, is to cool the economy down. So the Fed is looking at all those projections and what's going on in the market to determine their monetary policy, both with quantitative easing, which I'm not going to cover in this video, or tightening, as well as the Fed funds rate. But it does strip out affordability in the market the higher they raise those rates. So what do I think all this means as far as payments, and what should you do with this information? Well, that's the $1 million question. In the short run, the FOMO is getting stripped out of the market. The sentiment, if you Google sentiment towards houses, is down. A lot of people think it's no longer a good time to buy a house, right? They're scared of there being a market crash. And it's not invisible. People see that pendulum swinging the other direction. Again, no one knows what will happen. I personally don't see us getting 18, 19, 20,000 homes in the market, which is where you would start seeing a lot of negative depreciation. But I still think you're going to see price decreases, in the sense that sellers have listed their price 20,000 over the last person that listed their house. Those are going to start getting taken down to what the houses will appraise for in that area. Again, I'm not saying that's not going to happen. That's not going to happen the second. It could take a long time for inventory to come in. Central Florida is still only at 1 month inventory. But again, these forces are going to play out. The longer rates stay up, you're going to get more inventory of affordability. You're going to get less where houses are selling in one day, getting more and more, maybe back to a buyer's market, which I would like to see. Again, data's king. Paying attention to it, seeing where the puck is going, as Wayne Gretzky would say, is really the key, and just kind of making those decisions as you go. So if I was buying a house right now, I would say I would not stop the process because I was waiting for depreciation, because I think you could end up waiting forever. There's really no way to know, but that's my opinion based on the data now. And if rates drop, you can always refinance. And if rates were to get really, really low again, guess what's going to happen? Inventory is going to get low again as well. So anyways, longer video than I wanted, but I just wanted to give you a feel for what I think rates are going to end up. Somewhere at the 6% is where I see them stabilizing. 6.5% on the high side. We'll have to see. I don't have a crystal ball, but it'll be interesting to see how things play out. All right, with that, make it a great day. Let me know what I can do to help. I'll talk to you soon. Bye-bye.